Hello fellow compounders. So you've decided to become a passive income investor and you're looking for an ETF. You've come to the right place. This is part one of a two-part series featuring the best ETFs for passive income investors. Today, we'll review 4 dividend producing ETFs. I'll walk you through my valuation process and I'll give you my opinion on which is the best ETF for the dividend focused investor. And in the next video, part 2, we'll seek the best dividend growth ETF for the total return investor. Welcome to the Always Be Compounding Club, where we share ideas on how to build, grow, and enjoy wealth. I'm your host, Dennis Chen, a full-time investor and CFA charter holder. Welcome aboard. Let's get started. If you recall, in our last video, we reviewed individual stocks for the active or enterprising income investor. Today, we are moving to the other end of the spectrum. We're going to be looking for ETF investments for the passive or defensive investors. You know who you are. Those of you who don't want to do any work picking investments and just want an easy solution to set it and forget it. I know many of you. My wife is one of you. I have to say, it's a great way to invest. It provides for a stress-free, leisurely life. The exchange-traded funds or ETFs we are reviewing today are Schwab US Dividend Equity ETF, symbol SHD, the Vanguard High Dividend Yield ETF, symbol BYM, the Spider Portfolio S&P 500 High Dividend ETF, symbol SPYD, and the iShares Core High Dividend ETF, symbol HDV. Warren Buffett, in his 2018 letter to Berkshire shareholders, compared their investment portfolio to a forest with 5 groves. Following this analogy, investing in ETFs is like investing in a forest with groves and many trees, where each grove is a business sector and each tree is a business inside of them. These groves have different kinds of trees. Some are for fruit and some are chopped for wood. But as dividend investors, we're looking for a collection of businesses that produce dividends, like an orchard produces fruit every season. Best of all these orchards are tended by other people. This allows us to relax and let our money grow. And whenever you want to feel proud of being a business owner, all you need to do is to pull up the latest fact sheet of the ETF and look at the list of holdings, and you can say to yourself, I'm an owner of X, Y, and Z company. There are 10 factors I look for in a dividend ETF. We'll use BOO, which is Vanguard's S&P 500 ETF, as our benchmark to demonstrate. The factors are, number 1, the investment selection process. Do I understand it? For BOO is simple. It's the 500 largest publicly traded US companies weighted by market capitalization. Number 2, the dividend yield. What's a dividend yield? In a dividend ETF, I like the dividend yield to be at least 2 times higher than the dividend yield of the S&P 500. The S&P 500 has a dividend yield around 1.6% as of July 7, 2022. Number 3, the dividend growth rate. By how much is the dividend production increasing every year? BOO's dividend growth rate is 6.08% based on the 5-year average. Number 4, expense ratio. What's the cost? How much does it cost to maintain the fund? I'm willing to pay up to 0.25% in annual fee. That's 25 basis points. Remember, fees reduce your returns, so you have to keep them as low as possible. BOO has an expense ratio of 0.03%. This is very competitive. For every $10,000 you invest in BOO, you pay $3 per year. Number 5, how big is the ETF? BOO is around $226 billion in assets under management. Number 6, what's the issuer's reputation? I'm looking for an ETF from an established company that is not likely to go out of business. BOO's issuer is Vanguard, founded by the legendary John Bogle. Enough said. Number 7, risk-adjusted performance versus the S&P or our benchmark. Does it beat the S&P over the long term? If it does or doesn't, how volatile is it? This means, how does my forest compare to the S&P 500 forest? BOO's performance is 12.92% annually over the last 10 years, 11.27% annually over the last 5 years, and 10.56% over the last 3 years. And it has a 3-year standard deviation average of 18.64%. Number 8, composition. How many holdings? How many trees or businesses are in your forest? Which are the largest 10 holdings? How much weight do the 10 largest holdings have? This helps determine the level of risk. What happens if one of your trees or businesses get hit by lightning? BOO has 505 stocks. The top 10 account for 27% of the fund. The top 10 holdings are Apple, Microsoft, Amazon, Google, Tesla, Berkshire Hathaway, Johnson & Johnson, United Healthcare, and Nvidia. Number 9, diversification. Is your fund diversified enough to be the only holding in your portfolio? Will I be able to sleep well at night? Does the forest have enough different groves or business sectors? Can it survive a plague in the apple orchard and still produce other fruit? BOO's top 5 sectors are technology, healthcare, financials, consumer, cyclical, and communications. You can Google it, find out all the details of the portfolio. Factor number 10, valuation. Am I buying at a reasonable price? Is the value I'm receiving from this ETF worth the price? BOO's current PE is around 20, which equals to an earnings yield of 5%. Is it reasonable to be investing at 5% when you can get a 10-year treasury yielding around 3? Maybe. I think you could probably do better, but for now, let's just say it's reasonable. That's our benchmark. Now let's look at the candidates. SCHD, Schwab US Dividend Equity ETF. Factor number 1, the selection process. It replicates the Dow Jones US Dividend 100 Index. It selects stocks that have 10 consecutive years of dividend payments, a market cap of $500 million, a minimum average trading volume of $2 million, MLPs and REITs are excluded from the list, and it picks the highest yielding 50% of that list, and it takes us to the next filter. Then it selects the top 100 from the list that are ranked by 4 fundamental metrics, which are cash flow to total debt, return on equity, dividend yield, and the 5 years dividend growth rate. Then a modified market cap weight is applied, in which no stock will have more than 4% weight and no sector will have more than 25%. The good thing is that all this is done by the manager. You just need to understand what's going on. It seems to be a very reasonable strategy to me. Basically, we're getting a basket of 100 stocks that have paid dividends for the past 10 years and are fundamentally strong. Factor number 2 is the dividend yield. SCHD has a 3.39% dividend yield as of July 7, 2022, which is around 2.1 times the yield of BOO. It meets our screen. Number 3, dividend growth average for the last 5 years is 13.32%. Number 4, the expense ratio is 0.06%. Number 5, assets under management is $31.8 billion. Number 6, the issuer is Schwab, very stable company. Number 7, performance. It has gained 13.32% per year over the last 10 years, 13.24% over the last 5 years, which outperforms VOO by 0.4% per year over the last 10 years and by almost 2% over the last 5 years. This is very good. I mean, it's hard to find ETFs that outperform the S&P. 80% of funds don't outperform the S&P. This is one of that 20% camp that actually does. Number 8, number of holdings, 100. The top 10 holdings account for 42% of the ETF. The top 10 holdings of SCHDs are Merck, PepsiCo, Amgen, Coca-Cola, Verizon, IBM, Pfizer, Home Depot, Cisco, and Texas Instrument. Its top 5 sectors are financials, technology, industrials, consumer defensive, and healthcare. Is it diversified enough? Yes, I believe it is. That was point number 9, by the way. And factor number 10, is it a reasonable price? Current PE of SCHD is around 14.5 which means an earnings yield of 6.9%. Is it reasonable to be investing at 6.9% when you can get a 10-year treasury yielding around 3% or an S&P 500 at an earnings yield of 5%? Yes, of course. 6.9% is way better than what you're getting in the S&P right now. So I think it's a reasonable price. This ETF, SCHD, is a very good performer. It has outperformed BOO over the past 10, 5, 3, and 1 years. And it pays around 2 times the dividend yield of BOO. Next we have BYM, Vanguard's High Dividend Yield ETF. Number 1, selection criteria. BYM sorts the stocks in the FTSE USA index ranked by projected 12-month dividend yield, and it takes the top 50%. It excludes companies that haven't paid dividends in the past 12 months or are not going to pay dividends in the next 12 months, and it excludes REITs. That's it. That's a very straightforward plan. Number 2, dividend yield of BYM is 3.15% as of July 7, 2022, which is around 1.9 times the yield of BOO, the S&P 500. Number 3, dividend growth of average of the last 5 years has been 6.76%, which is better than the 6.08% of VOO. Number 4, expense ratio. VYM carries a 0.06% expense ratio, which is double BOO's, and it's the same as SCHD's. Number 5, assets under management of BYM is $37.2 billion. Number 6, the issuer is Vanguard. Number 7, performance. 11.18% per year over the last 10 years, 8.8% over the last 5 years, and 8.6% over the last 3 years. It has underperformed VOO by 1.74% per year over the last 10 years and by almost 2.5% per year over the last 5 years, and also underperformed by almost 2% per year over the last 3 years. This is bad. That underperformance over time hurts a lot. The only redeeming factor is that the volatility was slightly lower than VOO's, having a volatility of 17.39% versus VOO's 18.6%. Is that enough to justify the underperformance? That's a good question. Number 8, the number of holdings in BYM is 443 stocks. The top holdings account for 23% of the fund, and the top holdings are J&J, ExxonMobil, JP Morgan, Procter & Gamble, Chevron, Home Depot, Pfizer, Eli Lilly, Bank of America, and Avi. Number 9, is it diversified enough? Its top sectors are financials, healthcare, consumer defensive, energy, and industrials. Yes, I believe it is. And number 10, is BYM trading at a reasonable price? The current PE is around 14 or actually 15.4, which means an earnings yield of 6.5%. Is it reasonable to be investing at 6.5% when you can get a 10-year treasury yield yielding around 3% risk-free, or the S&P 500 with an earnings yield of around 5%? Yes, I believe 6.5% for this portfolio is a reasonable price. Between BYM and SCHD, I would prefer SCHD. SCHD is the fund to beat at this point. To save time, I'm going to skip the detailed evaluation I did for SPYD and for HDV. I'll quickly review their selection strategy, and I'll show you how their investment returns compared to SCHD. And I'll give you my one-line opinion of each of them towards the end of the video. SPYD, Spider Portfolio S&P 500 High Dividend Yield ETF. Number 1, its selection criteria. SPYD's selection criteria is simple. It sorts the S&P 500 stocks by dividend yield and buys the highest 80 stocks in equal weight. The fund rebalances twice a year in January and July, and that's it. Plain and simple. If you wanted to, you probably could copy this yourself. However, at an expense ratio of 0.7%, it's probably better to just delegate the work to a fund manager. Note that SPYD does include REITs. It's the only one except for VOO that we're reviewing that includes REITs. Number 2, dividend yield. It pays a dividend yield of 3.94% as of July 7, 2022, which is around 2.4 times the yield of VOO. This is the highest paying ETF that we've seen today. Number 3, dividend growth average for the last 5 years amounts to 0, which is horrible compared to the 6.08% growth of VOO or the 13.3% of Schwab or of the SCHD. Number 4, expense ratio. It's 0.07%, which is more than double VOOs and about 17% more than SCHDs. Number 5, assets under management, 5.8 billion. Number 6, the issuer is State Street. HDV, iShares Core High Dividend ETF. Number 1, selection criteria. Its strategy is to take stocks from the Morningstar US Market Index, screen the stocks that score well on Morningstar's proprietary wide moat and distant to default ratings. Then it selects the top 75 securities ranked by dividend yield. HDV also excludes REITs. Number 2, dividend yield is 3.14% as of July 7th, 2022, which is around 1.9 times the yield of the VOO. Number 3, dividend growth rate last 5 years is around 2.5%, which is bad compared to the 6.8% of VOO and the 13.3% growth of SCHD. Number 4, expense ratio is 0.8%, which is more than double VOOs and 25% more than SCHD. But 0.8% is still cheap. Number 5, assets under management is 8.2 billion. Number 6, the issuer is iShares or BlackRock. To sum up, as my old boss would say, show me the money. Here it is. If 5 years ago, in July 2017, we had invested $10,000 in each of the ETFs, we would have right now $18,600 from SCHD, $17,000 from VOO, $15,300 from BYM, and around $14,500 from SPYD and HDV. SCHD clearly beats all other ETFs. In fact, SCHD outperforms the other 3 ETFs and VOOs in the 3, 5, and 10-year periods. However, SCHD didn't do that well in the last year. Hold on, what happened in the last year? SCHD is in the last place compared to BYM, SPYD, and HDV. SCHD only outperformed VOO in the past year. The short answer is that information technology sector declined more than the other sectors, and VOO and SCHD have a heavy weighting in information technology, while the other ETFs, BYM, SPYD, and HDV, were underweight information technology. Also, both VOO and SCHD were underweight in the energy sector, which was one of the best performing sectors in the past year, and this accounted for the divergence. However, let me remind you that for this video, we are passive investors, not enterprising investors. I don't expect you to be analyzing the businesses held by the ETFs. We are buying forests, not individual trees. When buying an ETF fund, you're buying the basket and the selection process. We want a leisurely life, remember? Given that SCHD has outperformed its peers and VOO over the last 10 years, I would be very comfortable investing in SCHD, making SCHD the best ETF for the dividend investor. What about the other funds? Well, BYM, it seems okay. Nothing to write home about at 11.1% or 2% over the last 10 years with lower volatility. It's okay. I still prefer owning SCHD and or VOO. SPYD. I would stay away from SPYD because it has the highest dividend yield, no dividend growth, and very high volatility. This is a sign of a lower quality portfolio. HDV. HDV's strategy sounds good, but it has performed poorly. However, remember that funds at the top of the heap don't stay at the top, and funds at the bottom don't stay at the bottom. So it might be a good performer going forward. Who knows? In summary, I like SCHD. I hope this video was useful to you, and if you would like me to continue making videos that show how to invest intelligently and grow wealth, please subscribe, hit the like button, and place in the comment below the words "always be compounding" so I know that you made it this far. It helps with the algorithm and it supports the channel. Quick disclosure, I own BOO and SCHD. This video is for educational purposes only. I am not your financial advisor. You are responsible for your own investment decision. Thanks for watching. See you in the next video where we'll be seeking the best ETF for the total return income investor. Remember to always be compounding. Take care.